Welcome back to the channel, folks. This is Jason, certified financial planner and host of Fighting Words Financial. Today, I wanted to talk to you a little bit about the possibility of a pullback, what I think it might be saying about the economy as a whole, and what I would plan to do. And I'm not going to do it in that particular order. I'm not scripting any of this today. I'm just kind of letting things go. But let's talk about a pullback this year. I do think that we're going to have a pullback this year, probably somewhere in the range of 10 to 20%. I've mentioned this a couple of times through my Patreon group and on live streams. It's really because when you look at the technology sector and you look at the fundamentals of the companies that we're all interested in, and it could be fintech or genomic stocks or EVs, whatever it is, it looks like right now that stock prices have far outrun their company's fundamentals, which with growth companies, this is common. But at some point, the piper has to be paid when it comes to these growth companies. Either their revenues need to grow, even if they continue to have losses, even if those losses widen, as long as their revenues are growing, a lot of people will still be, will still have the faith to invest in those companies. Or, well, faith is a bad word. They'll still have the confidence to invest in those companies, thinking that, the money that's being earned is being reinvested into expansion. And, the biggest example of this is Tesla, of course. There are many, many times, if you were an early investor in Tesla like I was, where you could have lost confidence in the company. There were many, many long flat periods where you made an investment and I was actually down for like 2 years on one investment that I made in Tesla. I know folks can't even conceive of that happening right now, but I bought at one of those high points and then kind of like waited it out for 2 years at a loss. So that happens pretty frequently with a lot of these growth companies. Is you see rapid exponential growth and then the price stalls out for 6 months, a year and a half, and then it takes off again. A lot of investors, though, they don't have the patience to wait this out, or they try and trade around that, thinking they're going to make more money than the actual stock is going to make over time. So, folks, I haven't had just the advantage of going through market downturns myself and managing my own accounts. I've managed hundreds, thousands of client accounts too, and I can tell you from experience that the people that are most actively managing their money are the ones that don't make as much money. They make less money. For every person that you have right now bragging about the price that they sold this stock or that stock, there's 10 people that lost money and are completely silent. Even the loudest people that brag about how much money they're making in stocks, a lot of them really aren't making that much money in stocks. And this is borne out by research. Like it was Fidelity and Vanguard have both done research on their clients who are active traders. And they determine that they make far less money than buy and hold investors, even buy and hold investors that like to pick stocks, like the folks that watch my channel. So, look, I realized after kind of doing a survey here, and I'm going to do another one of those on my YouTube channel, but I realized after doing a kind of a survey of the folks that I have spoken to directly that watch my channel, that you're a lot younger than I expected, and a lot of you guys are new investors. So, if we go through this, this downturn this year in the market, and let's say it lasts for 3-4 months, which is, you see a pullback of 10-15%, or you lose 20 or 30% on your favorite EV stocks, you may be thinking that now is the time to sell, or you may be thinking that now is the time to load up. Buying on the dips is not a terrible strategy, but be careful about when you sell things. Okay, so anything that happens this year, and I say the market pullback that happens this year, I don't think will say very much about the economy in general. And I don't think that a lot of news coming out around a market pullback will really affect the way that I see the companies that I've picked. It won't affect what I see as their future, right? The business that they're going to be doing in the future. There's no fundamental news that we're going to be getting that changes my view of the success or failure of this company over the next 10 years. There's actually huge historical precedent right now for us to be going into a boom time. Like I think by 2022, it's going to be pretty clear that we're entering another sort of roaring 20s moment. And let's talk about that just for a second. So, Yahoo Finance just came out with a really great article on this today, written by a guy named Ethan Harris. And it's a quick article, but it makes a couple of really good points here. They don't believe that economic forecasters are looking at the whole story for recovery, and the recovery, really has just gotten started, and that the recovery from this, economic panic and this economic downturn looks completely different from 2009, and actually looks a little bit more like the economic recovery after the Spanish flu of 1918. The Spanish flu of 1918 led directly into the Roaring '20s, folks, which was one of the best economic times in the United States' history. Of course, that led to the Great Depression. We can talk about that a little bit later. But that was a decade-long economic expansion, and it was a decade-long good times for U.S. markets, good times for markets abroad as well. So a couple of big differences. Number one, the economic downturn that could have happened after the Spanish flu could have been pretty significant because all those soldiers were coming home from World War I. All those factories that had been making war materials suddenly went silent and they stopped producing war materials. Right? It could have led to an economic depression. They didn't have the stimulative measures that we have today, and yet it still led to it led to this great economic uproar. Right? So the stimulus that we had in 2009, which really helped the economy recover, was actually pretty feeble. It was pretty late, it was pretty small, and the effects of that stimulus faded pretty quickly. The response that the central bank had today and for this crisis was really timely. It was massive, and it's been persistent. We had benefits that paid out over the last 9-10 months or so, and it's helped keep the economy stimulated, right? So, and in this COVID-19 world too, there's a sort of second layer of stimulus that's about to happen, and that's all of the pent-up demand. Like, people have been cooped up in their homes now for a year or so. The economic situation for families is actually kind of better than we expected. The balance sheets for families look pretty good compared to what they looked like in 2009 in terms of debt to income. And I think there is this sort of deferred stimulus effect that's going to happen once the economy reopens, where, I know that I'm planning to travel just as soon as I'm able to. I know that folks that are planning to go to concerts as soon as they're able to, or eat out in restaurants 5 times a week as soon as they're able to. I think that the economic scars from this crisis, much like Mr. Harris said in this article, the economic scars from this crisis are going to be much less than the biggest banking and real estate crisis that we had, in modern history way back in 2009. But I think the real big thing here is that household balance sheets look pretty good, meaning during the last crisis, there were a lot of people who were kicked out of the middle class. It's a lot less obvious this time around, but there's actually far fewer of those folks who are kicked out of the middle class, and they're going to spend a lot less time recovering. Added to that, we actually have a second stimulus package that's going into effect. $1.9 trillion. I don't know if that's been signed yet, but I'm sure it's going to be at some point. It's going to be passed, or something of that sort is going to be passed. And this is actually going to have a sort of third layer of stimulus. So I do think that beyond 2021, we will see some sort of pullback, but the pullback is really related to money that's going to move out of tech, and it's going to go back into some of the more traditional sectors that are undervalued, that are not looked at right now, and that are seen more as recovery plays or sort of a return to normal play, right? And I think that 2022 and beyond is going to be very, very good indeed for the U.S. economy. Now, I am a bit of a natural optimist when it comes to the American economy because we are incredibly resilient, and you guys might disagree with some of the things I have to say. I look forward, as always, to hearing what you guys have to say in the comments. Let me know what you think about how I think the market's going to pull back a little bit this year, but then we're going to see a roaring economy sort of beginning in 2022. If you think I'm wrong, let me know in the comments below. I look forward to hearing from you.